Are stocks ever going to be able to maintain a bearish move beyond just a single day? I'm going to show you why not in today's video. There's a new sector that's coming from the ashes, so to speak, rising up from the ashes. Today's trade idea looks for opportunity within that sector, with the intermarket relationships being a good driving force behind that potential move. Let's go ahead and get started. Today is Friday, June the 1st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching us for the first time. Keep coming back for more. Glad you found us. Subscribe to our YouTube channel. Mouse over the logo on the bottom right corner of this video, and then click the red subscribe button that pops out. That will subscribe you to our channel. Like today's video. Click the thumbs up icon that's down below the video. We get about 1,000 views. We only get 100 some odd likes. So if you want us to keep doing these videos day after day, the way you tell us is with one click down there. Comment on anything that stands out to you from today's video. You have to scroll down to the further to the bottom of the page to do that. And then join our daily Market Outlook email list. There's a link that's popping out in the top right corner of your screen. Click on that link, and that will take you directly to where you can subscribe to our email list. Follow me on Twitter for more content like this throughout the day, throughout the week. My handle's up there on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned at the top of my timeline. Join our Market Outlook community on Facebook. Again, the address is up there too. You can see it in the top left corner of your screen. There's also a link in the video description below that will take you there as well. All right, well, let's take a look at the S&P 500 with the market forecast indicator here to start us off. And you can see 4 days, we started the week down below the 2-week range here and rallied all the way, all week long through some ups and downs, all the way to pretty much the high again of that 2-week period. So nice little bounce in the short term off this near-term low point, which was not a bullish, like I said before, not a bullish near-term low point. From on the blue line from low to low here, because while yes, it's great that we didn't get all the way into the reversal zone, it did not correspond to a higher low point on the index, so a little bit of a drop, but still a decent bounce nonetheless. After this high point did not get in the reversal zone, it did not produce a higher near-term high either. So that was a bearish, or not as bearish as it could be, but definitely not a bullish near-term high point, and then not a bullish near-term low either. We're kind of stuck sideways here. The ADX, the average directional index for the S&P 500, is unbelievably low right now. It's getting to one of its lowest levels, all the way down to, let's see, that's McDonald's, SPX, all the way down to 10. We were this low back last August, and that's typical for the summer months to get pretty choppy and not a whole lot of movement, and that's where we are right now. We had obviously some volatility here with the ADX up above 20, so we had some ups and downs, but now we're just not moving at all anywhere on the S&P 500. So we're stuck in this sideways action, but at least like right now within that action, we're pointed to the upside in the short term. We were at the beginning of the week, end of last week and beginning of this week, we were pointed to the downside in the short term. Now we're pointed back up to the upside. But still, while the posture is still strongly bullish, market sentiment is rising. It's still below 50, so that means we're still not out of the woods in terms of choppiness and sideways action here on the S&P. You look at the Dow Jones Industrial Average, up almost 1% today, not quite breaking up above those highs from the past couple of days like the S&P. As a result, still a bearish posture on the Dow Jones, so the intermediate line is dropping. That's why you have this light pink shaded area here, representing a bearish posture. Green would be when the intermediate line is rising up above 50. So bearish for the Dow Jones, but a bounce up in the near term. You can see the NASDAQ, after getting that overbought cluster last week, now moving back up closer to all-time highs, and you can see the near-term line popping up into the reversal zone with the potential here for a divergence. So lower highs potentially on the blue line developing, and you can see the corresponding highs are obviously much higher already. The near-term line would have to get up and stay up for a while above the 90s for us to kind of nullify the possibility of that bearish divergence, again considering how high we already are on the NASDAQ. So I mean, still bullish. We're still at a strong bullish posture, bouncing up, so great. And the near-term line, has been up. How many days now above 50? This was below, so 1, 2, 3, 4, 5, 6, 7 days now. That's about the length of time you look for in near-term rallies, is 7 to 12 days. And then finally the Russell 2000, which has been recently the most bullish of the indexes. You can see after breaking out Tuesday, and obviously none of the other indexes did, and pulling back yesterday. So Tuesday closing at Wednesday closing at 1648 roughly, and you can see getting right to 1648 today. So again, strong bullish posture. Market sentiment's a lot better looking on the Russell 2000, which, like I said before, gives us the anticipation of it improving on the other indexes too eventually. But the fact that they're not yet means still choppiness and sideways action, whereas with the Russell, we're breaking out and we've broken above those highs and we're trending higher on that moving average as well. A quick reminder for those watching the Market Outlook on our blog, and again for those who are not watching on our blog, there's a link just popping out in the top right corner that will take you there. But for those watching on the blog, for us to know what you thought about the video today, we want you to click on 3 things here. The tweet that's underneath the video, for those who have a Twitter account. For those with a Facebook account, you click the thumbs up icon right below that, and of course everybody here can click on the green thumbs up, and that will take you there too. There's the email sign up form if you haven't signed up for our email list, and there's a link that will take you to the Market Outlook forums. Remember, you have to subscribe up here in the top right corner. You have to subscribe to our forums to be able to participate there. From a long-term perspective, again, we're rallying. We finished a week strong after starting weak, and so we finished up above the 50-day moving average. Both the 50 and 200-day moving average are still rising. We haven't got an arrow for a few weeks, and that was what we talked about back here when we got the arrow. It's like, okay, now we kind of expect that we will go a few weeks without getting a red one after some choppiness and volatility earlier this year. Because we have some time for this to go up and make its way, not up to these highs again, but make its way up to form a lower high, similar to what we saw, through that grinding action there. Obviously not as flat as we're getting here, but still the same ideas. We go ups and downs, but the ups go up to lower highs as we, converge our way towards zero and towards a potential death cross that you get when the 50-day moving average eventually crosses over below the 200-day, like we saw back at the end of 2015 and again in early 2016. If you take a look at the 3 green arrow charts, we're looking for 3 green arrows. You get the green shading here too. You can see the moving average dipped yesterday just briefly, and that's why, but we're still above it, so that's why it turned yellow. Well, now it's turned back up again today, and we're obviously still above it. So Monday, you'll see that line here, the moving average, turn green. So that will be a positive, and you'll see it shading now occur again. So the more blue shading we have across the market forecast chart, that long-term chart, and this chart, that just shows how bullish we are, and we can tilt our active trading more towards that bullish side and take advantage of the trend. Stochastics turned up a smidge from what would be, or what can be a bullish phantom green arrow in the MACD. And when you look at the 2 line versions of the MACD, both turned up, both still below the moving averages, so not as bullish as we can be. But at least they're turning up, and they're both in the upper half of their charts, above 0 on the MACD, above 50 on the stochastics. And you can see after retesting the 17-day yesterday, back up above the 8-day today with all lines rising. So very positive, bullish pattern from that perspective. So we went all week here this week without forming a new 4-week high point. You see we are still kind of stuck. But at least we bounced back up. We held Wednesday's low for low yesterday, but we did break through Wednesday's high point today and got up to new highs and got up above Wednesday's high, as well as above all of the last week's highs from later in the week. Obviously Monday and Tuesday is when we got the new 4-week high point slightly, and then pulled back the latter end of the week while we eclipsed all those highs too. You can see where my cursor is right there. how it bounced up those levels. So, but a small range nonetheless, very small range. Again, going back to the market forecast chart, if you didn't see before, 18-point range in the SPX versus 28. So very, very small trading range there. Go back to the intraday chart. You take a look at the volume here. The average is declining, and it was a little bit below average volume. You can see both these lines are still falling. The ATR has not fallen below that 1% mark yet, so we're still relatively high in that regard. And then you take a look at the volatility index, which would be this one here first. And obviously the VIX pulled back down today with today's bounce, back below 15 after staying above 15 for most of the week. Back down into this kind of neutral range. So positive there, even though still it would be a higher low point for the VIX compared to the last one it had. And then you can see here on the comparison of the VIX to VXV, you can see we're back down below the 90% mark of VIX compared to that. So we're back below the neutral zone and into bullish territory again. So positive, small positive, because we're not that far into the bullish area, but bullish nonetheless. So to summarize, the market posture remains bullish. We've had a little bit of a pullback this week, and it might have changed or got a lot of people thinking bearish earlier this week, but the reality is things are still pointed, a bias to the upside. Now, we're not like clearly entrenched in a bullish trend like over here, like we saw before, because of where market sentiment is, but the lean is definitely to the upside. And I know, 2 days this week, it seemed like things were, trade wars and what was going to go on with Korea and tariffs and, oh no, what's going to happen? And the reality is, as has been the case, whenever there's been bad news, that the shelf life of that bad news doesn't last very long. And the trend, which has been bullish here, growing, but not really firmly, strongly established, but still growing and new, it's still intact, that bullish trend. So what do you think? Do you agree? Do you disagree? There's a window that's popped up here in the top right corner of your screen. Click on that and click in that poll and tell me what you think about the market posture. And if you don't agree with what we've been talking about, you see something that I haven't pointed out that would suggest that we're not as bullish as we should be, comment down below. All right, now let's talk about what's driving the price action today. You can see crude oil had the biggest down day today, down 2.25%. Started off today low, along with long-term bonds. Long-term bonds actually rallied off their low point slightly, but still finished down. This was a risk-on day today. Emerging markets rallying up 1.25%, outpacing developed. Small caps didn't really gain a whole lot versus the S&P 500. But you can see these large cap stocks, which have been beaten up a little bit more, they fell the most. Here's the day on Tuesday. If we were just to look at what happened on Tuesday, remember large cap stocks fell the most with the trade wars and the issues that were going on overseas in Europe, right? All that was happening. Well, off that low point at the end of the day going forward, you can see stocks pretty much rallied. Small caps were at first, and then small caps pulled back, and then large caps bounced up today. All these stock equities coming up off their lows, 2% or more, really putting pressure on bonds and gold and the dollar, all down off that low point. So risk on move. You can see high yield ended up being down too today, which is not the best sign for risk appetite. Usually you want to see high yield up above zero. Not as high, obviously, as stocks, but still outpacing, and you can see it barely outpaced treasuries on a really risk-on day. So not a risk-on day in the bond market, at least. Outperformance, but not a gain. But everywhere else, positive moves. Even with the dollar being up today, the emerging markets rallied. But man, look at crude oil. Crude oil really falling quite a bit. If we were to take a look at the chart for the futures contract here, You can see now the intermediate line, dropping below 50, strong bearish posture below a falling moving average. So, we are pulling back. And in fact, we almost came close to a cluster today with the near-term line and intermediate line not quite there, but still a pretty big move on a daily chart. Now on a weekly chart, it's a little bit too much. You can see the weekly chart actually, it kind of looks like here, where you had a big drop on the momentum line after that 2-day sell-off, brought the near-term line below 50, and then we bounced up for 6 weeks. Well, here we're getting a 2-week drawdown, but it brought the near-term line to an extreme low too. So last week brought the momentum line down. This week, keeping the momentum line down and dropping the near-term line down, with a still strong long-term trend according to both the market sentiment and intermediate line on this weekly chart. So kind of interesting to see, on a long-term basis, yeah, we've pulled back, but not trend changing pullbacks yet. You can see this was one I want to look at and take a look at crude oil over here, and again below the 50-day moving average this week, but still up above an easily rising 200-day moving average there. So go back to the market forecast chart, and you look at the counterpart to those commodities, in particular energy, and you can see the dollar strengthening, bouncing back up just a smidge today on the daily, and of course on the weekly chart. It's been bullish for the last so many weeks with that euro weakness, and now we're seeing, okay, is in the short term, are we gonna, that's a doji pattern here on the weekly chart. Are we going to now reverse in the short term? And if we do, how far down are we going to go? Again, long time frame here, a weekly chart. So we'll see, if it drops down and ends up forming a right shoulder for this potential inverted head and shoulders pattern. Of course, if it does, if the dollar does pull back in weakness, we've seen, the impact it would have on gold would be bullish. Gold's been struggling a little bit here, pulling back during the 6 weeks, but still relatively sideways. You can see the intermediate line has fallen almost below 50, but not quite. And the short-term line just starting to come up, so it's trying to find a base there. So a weak dollar would help with that. And of course, emerging markets have been struggling during the 6 weeks too. And you can see the short-term line starting to bounce up on those as well, and looking for some relief in the short term for the next week or two on these areas where that are more impacted by the direction of the currency, of the U.S. currency. Of course, the big news in the day comes from the employment situation. The ISM manufacturing came out a tick higher than where we were last month, and still relatively high figures. So looking good from that perspective. Construction spending also came out, and it's the year-over-year change that matters the most. And look at that bounce back up. So that's a positive development from 3.6 to 7.6. So a good sign for construction spending there. And of course, the big one was the employment numbers. The last month was a low figure, revised a smidge lower. We were expecting higher. We got higher than that, and that brought the unemployment rate down to 3.8%. Participation rate dropped. That helps the unemployment rate improve. And you can see average hourly earnings still very strong at 2.7%, kind of meeting the consensus, ticking up a little bit there too. Positive across the board, and including the year-over-year rate of payroll growth continuing to trend higher, as we absorb that small month of hardly any jobs gains. We start to continue to push up. So a positive trend for job gains there. Positive report. And what that did, it did a couple of things. Economic surprise index bounced up a little bit, still low. But look at the GDP estimates with construction spending in the employment report and manufacturing, bouncing up to 4.8%. And estimates for rate hikes taking off again. So last week we were around 90%, and we're still there. That's for June. Pretty automatic. We'll get another rate hike at the next meeting later this month. But of course, September, pull that one up here. Here we go. In September, you can see the odds jumped from yesterday up to 66% now. 2/3 odds. We'll get the third rate hike and that's actually a little bit down from what it was earlier this morning, but still a bounce up for today. And you can see for December, the odds of getting the fourth rate hike, which had dropped down to 25%, jumped up to past 33%. So again, from with the rate hikes expectations rising, it's not a bad sign. It means that things are looking good from an economic perspective. And while we have been pulling back, and those rate hike expectations pulling back along with this line, there's a possibility that we can jump up higher. And remember, as this jumps up higher, typically corresponds and might put some pressure initially on stocks when these rise, but as long as this stays up high, it's okay, right? Because that's what happens. Economic growth occurs and inflation goes up, commodity prices rise, inflation rises, the Fed raises interest rates. That's normal for a bullish market cycle, typical of a late bullish market cycle. So keep our eyes on that. Doesn't mean like late as in the last day, but we are towards the end stages, however long this may last. But definitely keeping our eye on when things can definitely start to turn. So with the move higher in yields and the risk-off-ish nature of the day, not surprising to see utilities down here at the bottom, down 1.5% on the day. Staples flat for the day, and real estate just a smidge, small gain. Energy stocks were not down today, even with the big drop in crude oil prices. So they were actually up a half. Now they lagged behind the market, only gaining half of what the market did. Whereas the big winners were the technology sector and materials. If you were to zoom out here, materials has been a weaker area. In fact, it was down with energy stocks towards Tuesday's low point. From Tuesday's low point up to the high, energy was up energy stocks were up 3%. Materials also bouncing back up, and then there's your utilities and staples lagging behind. So materials, energy, technology's been a front runner. I mean, when you look at the not this chart, when you look at is it that one? No, that one. When you look at it on here, it's one of the sectors with discretionary. It's been so strong, and look at the breakout move it's had, getting up to these old highs from back in March. So it's been strong. Discretionary's been strong. Didn't bounce up as much today. There's the drop in utilities, the staples pulling back, but it's kind of dropping down. Most of its pullback was yesterday. Materials had been pulling back here. Its intermediate posture has been weakly bearish, falling intermediate line, but above 50. Energy is also falling intermediate line, a smidgen above 52. So they have been pulling back. Again, a strong dollar usually puts some pressure on these. But, again, look at material starting to bounce back up. There might be some opportunity as it gets back up above the moving average. And intermediate line turns back up from here would be back to a stronger, not the strongest that it could be when it gets above 80, but, at least getting above 50 or being above 50 already would be a positive sign for that sector to start to gain some strength, or these other strong sectors really not going anywhere. Healthcare flat, and discretionary is flat, and energy bouncing up a smidgen, and financials being down as much as they were earlier this week. All right, one stock that's in that material sector that's looking like it's trying to find some support there, and you can see on the chart it's FMC. It's pulled back down to its 38% Fibonacci retracement of this kind of earnings-fueled rally that we had. There was earnings right there, and past that earnings, after breaking out above that high point in an inverted head and shoulders pattern, we rallied up, broke out, and got up to this 92 area, back into this area of resistance, pulled back down, and sitting on that 38% Fibonacci support with multiple Haramis over this past week. There's opportunity for a bounce and move our way into, and you can see that the rest of this Fibonacci retracement zone is still up above this area. So this 84.25, getting below 84.25, If we were to not bounce and break down, that would be our sign that, okay, not so bullish, right? Not gonna be able to maintain this new trend that's on. But pretty good pullback here, and pretty good opportunity for a bounce off of support. There's the Fibonacci retracements. It's the moving average there, 6-week moving average. You can see the near-term line had pulled back. We got a bullish near-term divergence here, and both these short-term sentiment lines are moving higher. And then if you look at the 3 green arrow chart here, FMC, and you can see, you know, we pull back down below the 8 and the 17 day. We like to get up above that 8. But like we've seen on other charts, the MACD and stochastics have been falling. They've kind of meeting up, getting to their midpoint. The MACD, the stochastics is dropping, falling below its midpoint, but not falling into that reversal zone quite yet, and they're slowing down their pace of declines. So an opportunity here for see if we bounce off of this low, which we have done in the past. Last time we were kind of at this level and bounced off a low point. We rallied up to 98. Right now, if you look at the between now and July expiration, how far it can go up, and you can see, you know, 96 is, according to current volatility levels, would be a 1 standard deviation move to get up there on one half. On one side, getting down to 81 or a little bit below it would be the other direction. So, you know, again, with a bullish bias, we could say, okay, well, we can speculate a little bit and speculate on that bounce with materials improving and looking better, and this stock within that sector looking better, you know, having been pulled back and now potentially gaining some momentum there. Then we can look at potentially buying this and changing the Theo price up to 721 to that July expiration, and getting up towards the top end of that 1 standard deviation move. So just kind of a round number there. You can see this highlighted. This is the current price, and they're relatively wide spread, so you have to kind of play around with what price you get in at, right? So right now the market tells you, you know, to buy it at 225. You might be able to buy it at 220 or somewhere close by there, like you know, 220 or 2. It's a nickel wide spread, so you have to go with either one of these. But you can see that's, you might, you know, 220 is where the market's telling you right now. So we'll see if that's the price you end up getting. And then if we do get in at that mark, then and the price of the stock does go up that $7 by July expiration, then you got a pretty decent return there. And the benefit of it being so cheap, the options being so cheap, is that we can position size around that full $225 loss. So we can do, say, 5 contracts here, which would be about a 1% risk if we were to take full maximum loss of our portfolio balance, and then, you know, let this thing run and see how far and how much it can go up to if it were to bounce off of this. And if it doesn't bounce off of this and breaks down below this 84 level over the next few days, let's say over the next, here, let's analyze this. So here we are, and let's say over the next week, so by next week, instead of bouncing, it drops to 83. So below that 84 support, right, the Fibonacci zone that's in this area, then you can see we'll be down, you know, almost at that $1,000 risk at $882. And again, if we make our way to the upside to that 95 and a quarter level in that area, then there's our potential reward. So pretty decent reward to risk ratio, a couple $1,000 opportunity for profit if it does bounce and continue to make its run to the upside. You see, it only has to get to 92 today to get a 1-to-1 reward to risk ratio at the worst case scenario. So it's a swing trade. It's a speculative swing trade. You might even position size smaller than what you normally do for these types of trades. But again, steering our way towards the sector that's showing some relative strength after being beaten up a little bit, and then also and would gain from that weakness in the dollar if there is any near-term weakness in the dollar. And a stock like this, which has been, you know, beaten up itself, pulling back to some pretty decent levels of support and looking for the possibility of a bounce off that support. So what are your thoughts on today's market posture? What are your thoughts on the trade idea that we have for today in this material sector? Let me know. There's a link that just popped up in the top right corner of your screen that will take you to our Market Outlook forums. So let's chat about what you got out of the video today in the forums with me as well as with other members that subscribe to MarketScholars.com. Thank you as always for watching our video. Remember to subscribe, like, and comment down below on the YouTube channel. Remember, you can do the same thing on MarketScholars.com. You can subscribe to our site using our link in the top right corner of the website. You can also like the video like I showed you earlier today, and then comment on the blog post or comment in our Market Outlook forum. So you can do all the same things on our site too. Have a great weekend, everybody. A nice, great early to the summer, beginning to the summer weekend. We'll see you all on Monday.